Back in the 90s, I started and managed the hedge fund sales business in equities and equity derivatives for Goldman Sachs. I then, in the early 2000s, went to GLG Partners, which is now Man Group, which was the largest hedge fund firm in Europe at the time, where I started and ran their global macro hedge fund. Then I moved to the Mediterranean coast of Spain, sort of semi-opted out of the rat race and started writing macroeconomic research for the world's biggest global macro funds, hedge funds, sovereign wealth funds, family offices, that kind of thing. So my background's basically 30 years of global macro. Then I'd gone through the financial crisis in 2008, and I was, one of the people who was kind of at the epicenter of predicting what was going on. A lot of people in the film The Big Short were kind of clients of mine, and I kind of knew a lot of how this might play out. The same happened in 2012 when Europe almost fell apart. So I was thinking, why me? Living in a beach town in Spain, how come I've got all the access? And people in the street would come up to me and say, well, why didn't we know? And I thought, there's something wrong here with the distribution of information, that only some people could get it and others didn't. And that's why I started Real Vision. So Real Vision is basically a video-on-demand platform. It's actually larger. It's now a broader media company that basically concentrates on helping other people gain access to the world's most preeminent intelligence, financial market intelligence. And we do that by interviewing the world's most famous hedge fund managers, independent analysts, strategists at length. Also in that journey, so I had a journey that I wanted to help educate, level the playing field, and understood that the world had changed away from the intermediaries to a disintermediated world. And I wanted to play a part of that, and video was the big answer. But in that journey, having gone through those two huge crises so close to each other, and having almost lost the banking system in Spain, I started a journey of trying to figure out, could I set up the world's safest bank? I know that's a slightly kind of crazy, arrogant thing to think, but I thought I'd give it a go. So we got together with a bunch of others, and we went around the world to Singapore and the Middle East and to Switzerland and the US trying to do this, and it became hard. And one of my clients at the time kind of tapped me on the shoulder and said, you should look at Bitcoin. Maybe this is your answer. So this was 2012. And so I learned about it. I invested in it for the first time. It went up 100% in a month. And I closed my position, took my money and went, wow, okay, this is not normal. And then I kind of did the first analysis of stock to flow, meaning I looked at it like gold and thought, well, with this much supply and this much gold above ground and this much known reserves, if we imputed the same thing for Bitcoin, when gold was at 1,300, Bitcoin should be at 1 million. So I'm like, okay, this is interesting. This, from a macro perspective, looks cheap. So that started my whole journey. And I also realized that after 2012, the next global recession would see this parallel financial universe using blockchain technology meet this macro world of excessive debts, a financial system that's somewhat fragile, and all of these things would have a horizon point. And that all happened last year.
So, Raoul, how do you think the digitalization of finance, including blockchain, tokenization, crypto, etc., could impact such a huge asset class like the bond market in practical terms?
So, at top level, the internet grew at an adoption rate of 63% a year from 1999 to 2000. That was the fastest adoption of any technology the world had ever seen. Crypto, in its broadest sense, is actually growing at an adoption rate of 113%, twice the speed of the internet. So this is of an order of magnitude none of us have ever seen before. And most of our narratives are somewhat behind what's actually happening because so many people are working on this. But what I think is going to happen to the financial industry, I think it's actually going to change all global business models. But to the financial industry, we know some of the big problems that have been outstanding. Things like rehypothecation. What happens at things like DTC level, CC level, or Euroclear? Who owns what asset? The ability to tokenize these assets is a game changer. And the ability to trade 24 hours a day instantaneously and fractionalize it is also a game changer. So I can't see any reason on earth, while all equities and all bonds are not going to go into the blockchain. We've also seen the rise of DeFi, and that's decentralized or somewhat centralized lending protocols and borrowing protocols that work algorithmically, seem to be pretty robust as far as we've tested, and that looks like that will scale as well. So what we're doing is we're creating a modern system of finance that's more accountable and suitable for the modern age, that doesn't have T+1, T+2 settlement, but instant settlement, that allows the instant transfer of assets. And once you blend in the central bank digital currencies, you've got rails of which all of this can operate globally. So if we think of the size of the asset class today, and Mohammed said, or it's around, or you said that it's somewhere around $2 trillion. If we look at the global equity market, the global bond market, global real estate, which can also be tokenized, all of these things, they're between 100 and $200 trillion assets. If we look at the adoption rate, it's kind of suggesting to us that this blockchain technology is going to end up as a 100, $200 trillion asset. I think it actually encapsulates all of these other asset classes because it's a much more efficient way of transferring, owning, proof of ownership, all global assets. So I think it's really big and it's hugely disruptive. As Mohammed said, we don't know actually what format the central banks are going to do this. My guess is they'll start with the non-disruptive version, as he suggested. I think they will move towards the disruptive version. We're already kind of getting noise of that out of the US, that maybe they want to do it in conjunction with the private sector. Maybe DeFi is an efficient way of doing it and fintech is an efficient way of doing it. Do we need money center banks? Okay, that's a big change for the world. Or money center banks have to reinvent themselves. That's fine. That's what technology does. It strives all of us to improve our business models or adapt. So, yeah, look, it's really exciting times for finance, and it's bigger than finance itself.
There's been kind of a lot of noise around the ESG, how it factors into crypto and blockchain over the past kind of 2 or 3 months. I'd be really interested to know kind of what your perspective is on that topic.
Yeah, firstly, I think we need to be careful in what we compare. Right now, we're not comparing Bitcoin or crypto to anything. We're just saying it uses a lot of energy, right? Same as when we use kettles. My guess is global kettle usage is probably higher than Bitcoin. We just don't think of the world in those terms. How much does the banking sector use? We don't know, right? It uses electricity. In fact, it uses electricity and stores it. It basically mines electricity and turns it into bytes, and that's transferable. So that's where part of the value proposition of Bitcoin itself comes from. But transactions are not highly cost. They don't use a lot of electricity. It's only the mining that's expensive, and it's only for Bitcoin, because Bitcoin is a particularly kind of pristine way of doing things that requires a huge amount of computational load. So that's expensive to do. So, okay, so there's only Bitcoin with that, because Ethereum is moving to proof of stake, but it also has side chains and other things that are very efficient in terms of energy use. So most of the whole rail, so that's why the EIB used Ethereum for their, foray into digital bonds, because, it's not very energy intensive compared to most things. So that's okay. So really that story goes around Bitcoin. But when we dig into the story of Bitcoin and its energy use, as I said, part of the value proposition is that. But if you look at the speed of which Bitcoin mining is moving to green energy is probably faster than any other industry in the world. Why is that? Because all the costs are in the electricity, and the cheapest marginal cost of electricity in the world is geothermal and hydropower. So we're seeing a lot of that, and then there's new technologies in gas flare-offs. We've seen huge wastage of energy, also load balancing for electricity networks. So we're finding a lot of ways of actually making either existing networks more efficient by Bitcoin mining, or by actually driving the technology to greener sources. So we're seeing this big rise in Canada and Texas. Canada because they've got gas flare-offs, or they've got geothermal or hydro, and it's cool so you can run servers. Texas, huge amounts of gas flare-offs. Or when we go to Iceland and other countries in the north, even in Russia, we're seeing all sorts of different uses of electricity. So net is actually a disruptor to the energy world, and I think it's less intensive. And Ethereum, which is really the rails, the platform for most of the industry, where a lot of the financial sector will start to focus its efforts, that's much, much less intensive anyway.
Great, thanks, Raoul.